Where could the S&P be headed as we move into the final quarter of 2022? The Chartmaster re-upping his message from April. Expect some red arrows from here. Let's bring in Carter Worth of Worth Charting for much more. Hey there, Carter.
Hey, Frank. Thanks so much. Well, I mean, I think we know this, that there is this hope, right, that because the dollar has cracked a bit and that yields have come in, that somehow the S&P is off to the races. I think it's going to be dollar lower, yields lower, and equities lower. Look at this first chart. We know how well defined these lines have been. The bull case, not mine, look at the next chart, that we were to have yet another rally, and that rally takes us right back to the downtrend line in effect since the Jan 4 high. If that's your premise, not you personally, you generically, you're talking about 8% up from here. The bear case, that we crack, that we don't sort of bounce, put in double bottom, you can see it on the next chart, and that we are heading down into the 3,300 plus minus level. I think that is the scenario that's likely. But we certainly know this, that there are a lot of people on both sides, and it will be determined one way or the other. Let's talk about yields, because that seems to be the thing that is the flavor of the day. This is a very minor short-term chart, basically since August 1, and the dip in yields leaves us right on trend. Now, could we go a bit further? Yes. Take a look at this longer-term chart, and then quickly to the final chart. What we have is a dip that leaves us almost back to that spike high of June. The real question is, are we headed materially lower? I think so, and I think that while that would be considered on the surface a positive for equities, it actually is going to be something quite the opposite.
All right, Carter, just to be clear, your point of view is the bear case in the situation. The S&P falls about 10%. So is key to that interest rates continue to climb, or are there other things that could make your bear case turn out to be true?
No, I'm saying I think you've reached the point where you're going to have interest rates not go higher, and equities are actually going to realize that it's for the wrong reasons, and equities go lower as well.
All right, Carter Worth, we appreciate it. All right, let's trade it. Karen, I'm going to come over to you. I was looking at the monitor while Carter was talking, and you were kind of looking at his thesis there. What's your take on what Carter's saying there?
Well, so it's very interesting. Carter's obviously really good at his job. I was wondering, does the bounce scenario mean the other scenario doesn't happen? And I'm wondering, could we see this bounce first and then the down lower past that trend line? And so that would be quite a big fall from a bounce. That absolutely could happen. I guess, you know, my compass is always, I'm always long, so I'm always, you know, more optimistic. And I think that if rates do go lower, that will inherently be good for stocks. I know he's saying that's not the case, but I think that it will be, particularly for the high flyers who've been decimated. That's not that's not in my portfolio, but I do think it would be somewhat of a floor for those stocks.
Julie, what do you think?
Yeah, I think it's an interesting point, right? Because to me, Carter's point is actually more fundamental. And it's, if interest rates are declining because the fundamentals are deteriorating, inherently that's problematic for equities. And, I agree that there is so much desire to tick the bottom. And that seems to be what drives all of these rallies, is this idea that, oh, we've reached it and we're all going to jump in all at once. And I think we just have to let the fundamentals play out, because it's important to keep in mind that the rally that we experienced over the last 2 or 3 years, yes, fundamentals were good, but a lot of it was valuation driven and connected to low interest rates. And so we're still not at a point where equities are really that cheap. And so it's hard to get really bulled up and enthusiastic when you haven't had this real capitulation where you threw out the baby, the bathwater, the whole bathroom. We're just not there yet. And I think it's just going to take time for that to circulate through the fundamentals.
Yeah, capitulation has been a big word for this market in recent months. Guy, are you agreeing that we're still a good ways away from the moment of capitulation?
I haven't seen, the only panic I've seen over the last, except for a couple days since January, has been to the upside. And I'm not suggesting today was panic at all, but you have seen, typically we associate a panic with selling. I would say since January or so, you've seen panic buying at least 4 or 5 different times. So let's put that out there. I don't think we've seen capitulation to the downside, number one. And, I think there's this misguided belief out there, and I'm not suggesting anybody on this panel says that, but, somehow if the Fed does pivot, all our concerns of going away. That's not the case. The reality is we're in a period of slowdown, slowing revenue growth, slowing earnings growth, and how much you're willing to pay for this earnings in this environment, and we're still too expensive. So earnings are going to come down. We're seeing a slowdown right before our very eyes. And even if the Fed were to pivot, it's not going to cure the ills that corporate America are feeling right now.